All right, what's going on, everybody? Physio Trader here, and in this video, we are going to be talking about retirement planning. Now, for those of you who are either running your own business, there are a couple options you can take. Most individuals have heard of the traditional 401k, which just pertains to the IRS tax code. There is another one that is very similar, known as the 403b. You are typically eligible or beneficiary of that program if you work for the state or the federal government in some way or form. A couple other programs that do exist are what is known as the Simple IRA or the SEP, which stands for Simplified Employee Pension. Now, if you're just getting started and you're just starting to utilize your own business and you want to put a little bit of money away, that was always the one to do, which is known as the Simple IRA, and that is because it is simple. There are very few rules attached to it and basically just says, put your money in here and then you can tuck it away. The major rule that does exist is once you do open that account, you can't do anything. You cannot convert that money over or transfer it to another retirement type in the future for at least 2 years since beginning to make your first deferral. Apart from that, the simplified employee pension is very famous because it is just that, it's simple. But in today's day and age and making things so easy, I have always recommended the 401k. You have the highest contribution limits, but you also have the most flexibility on what it is you can use that money for, whether it's investing in stocks, bonds, mutual funds, real estate, gold, etc. Now, when it comes to picking a 401k broker, you have your choice. I use Charles Schwab. One of the reasons I use them is because with my business, I use them as my broker. And the reason is that I can pick whatever it is I want to invest that in. What I do like about doing this, regardless of who your broker is managing that money, many times individuals will use companies like Fidelity, ADP, Schwab, or I use, or a handful of other brokers. They're going to give you benefits for using that. One of the reasons I use them is because it's free. It costs me $0 ever to have my money with them. I certainly don't like paying someone else money to hold my money. I don't like doing it, and I don't think I ever will. The second one is that I can put that money in anything I want. If I want to load the boat and put it all into Tesla shares, I can certainly do that. No, I wouldn't advise it, but I could certainly do that. So I have a lot of flexibility. I like the ability that I can pick and choose what it is I want to put my money into, whereas when you stick with something simple like ADP, most of the time, they only give you a handful of anywhere of like 10 to 20 mutual funds that you can put it into, maybe an index fund or two, and that's it. Your choices are quite limited. Now, that, again, is a video for a different day. That is certainly up to you, your CPA, your lawyers, and everyone else to figure out together. But for those of you who are considering doing a 401k, there are a couple things, a standard 401k that is, there are a couple things you need to look at too. There is these 3 rules and regulations that have been set in place that are known as discrimination, or more importantly, these non-discrimination tests. There is a series of 3 tests. The first one is an individual that is highly compensated putting more money away than those who are not highly compensated employees. The second one is the person who is highly compensated getting a different deferral or a match than somebody who is non-highly compensated? And then the last one, which is known as the top-heavy test, that is the vast majority of the money or the bulk of the funds in that 401k plan, is it from highly compensated employees? And if it is greater than 60% of the entirety, then typically you are out of compliance. Now, what do you do and how do you get out of it? So I found a great article, so let's look at it. Now over here, this is from guideline.com, and here it is talking about the different benefits of your 401k plan. Now, the biggest question of all of this is, does your 401k plan benefit all employees equally? Now, it does not matter equally as far as the same dollar amount, but more of equity as far as is everyone being treated fairly. Now, what do you do with that is there are the 3 non-discrimination tests. To help everybody out save for their future, you have to differentiate who is a highly compensated employee versus, and these are typically your owners or individuals making over 6 figures, or are they non-highly compensated employees, basically everybody making under 6 figures. There are 3 annual tests that a 401k sponsor, that is the company holding it, must pass. The actual deferral percentage test, which is just a percent of how much money you put in. So if you take $100,000 a year, that's how much you make, and you put $10,000 in, then you put away 10%. And the idea is that you cannot be grossly different than other individuals, namely the non-highly compensated. or the actual contribution percentage, which would just be a percentage of your money, not just the percentage of the total number of money passed. Again, we can go through this more, but the third and the most important compliance test to pass is what is known as the top-heavy test each year, and that is where you have to keep that all of those individuals in the plan, all the highly compensated employees in the plan, do not make up more than 60% of all of the money in that plan. Now, there is one of the major questions that gets asked is, what do I do if I'm the owner? I'm obviously going to be highly compensated, but the individuals who work for me, they're not going to work for me all that long. So, or maybe they're not going to be with me for the years and years and years that I anticipate to be the owner. Or maybe you're a doctor or a lawyer or an engineer, and the people working under you, quite frankly, just don't make in your salary range. Well, what do? Again, it comes down to is some of those businesses, there's a ton of non-highly compensated employees, and so it could help even the score. But here's one, and one that I highly suggest, and is very easy to overcome all three of those non-discrimination tests. So what you do is you are going to come over and you are going to create what is known as a safe harbor. And so coming over here, let's see. So as a review, here are the non-discrimination tests. You can see amount of income, deferral percentage. This is the money that they provided. The amount of income, percentage, and as you can see, Jon Snow makes more money, but he is contributing a significant more amount. He is failing that test. Once more, on the second round, he is failing that test. And then on the third round, I'm going to link this up so you can kind of skip through it faster. But what do you do when you fail this top-heavy test? And so this is what the IRS defines as key employees, officers making $200,000 or more, any individual who owns 5% or more of the business, or family. And that is the important one. And again, a plan fails the top-heavy test when the value of the assets in each key employee's account is more than 60% of all assets held in the plans in that plan. Now, how do you correct it? You basically have to give money back, which is going to piss off a lot of your employees or you. Now, there are a couple things you can do, and the first one is you can join and you can create a safe harbor plan. When you are in a safe harbor plan, you do not have to follow any of those discrimination rules. I'll repeat that again. You do not have to follow any of the non-discrimination rules. The reason is because they're already set in place to not be discriminating against your employees. Here's how. Basically, what you're doing is you're going to be giving your individuals, the employees of that company, you're going to give them access to that money right away. And the short stick of it is that you're going to have to give them the ability to access their money immediately, and their vesting will take place immediately. So let's get started in setting up a safe harbor 401k plan. Safe harbor plans require that you contribute to your employees' retirement 401k account in one of two forms, a match or a non-elective contribution. That basically means that when they put money away, you're going to match the same percent for everybody, or you will make a non-elective contribution for everybody. This is important because by doing this, by treating everybody equally immediately, then for those who choose to participate, then you get to stay away from the discrimination test, and you are fine with the Safe Harbor 401k plan. It is important that you do clarify with all of your employees in writing immediately upon employment that you are involved in a Safe Harbor 401k. So the main requirement for the traditional 401k is that the employer must make contributions. If you're the employer owner, you likely are making contributions anyway, and those contributions must vest immediately. And what it means is it invests immediately for everybody, meaning your employee does not have a lockup period where they don't get access to their money. And quite frankly, if you're not doing this anyway, you're probably a scumbag, or the person you're working for is a scumbag, in which case you don't want to work for them anyway. Contributions, they can take up to three forms. The first two are matching, which means the employer must defer funds to their accounts in order to receive contributions. That basically means that employees say, I want to take X percent out of my check, and then the employer is going to match. This is very common when you see the I match 3 for your 5, or 5 for your 5, or 5 for your 6. There's a series of different ones where it works. The other third option requires the company to make a contribution to everybody equally, even if their employees don't defer any of their income on their own. So here is the different contributions. The basic matching, the company matches 100% of all employee 401k contributions up to 3% of their contribution, plus a 50% match of the next 2% contribution. This is the minimum that you can do, and this is what I meant when I said that the 3 for your 5. Or this one is 3 for 3. And this is, so a lot of times this is what is called your 4 for 5. So you're basically getting 4% match for your 5%. As you can see, the first 3 is equal, and then plus a 50% match for your next 2%, or 50 for 1, 50 for 2. So a total of 4% for your 5% match. So this is very common, and you'll notice a lot of employers are doing this. The second one would be what's known as enhanced matching. The company matches at least 100% of all employee 401k contributions up to 4% of their contribution or compensation, and it does not exceed 6%. Again, very, very similar. 4 for your 5, or this one, a minimum of 4% for everybody, but does not exceed 6%. Again, 4 for your 5, 4 to 6. And then the non-elective contribution, the company contributes at least 3% of each employee's compensation, whether the employees make contributions or not. Most individuals will basically fall into this category. It is the most common, and if your employee decides that they do not want to put any money in, then you do not have to put any money in. And so it is a way to keep you safe in the safe harbor with only paying people who want to be paid. Once more, you don't have to do all 3, you just have to do 1, and you are out in the clear. So here's a little beautiful chart that they made up. So the percentage of W-2 income, $0, 0%. In the first one, basic matching, you do 0. In the enhanced matching, you do 0. And the non-elective contribution, you do 3% of W-2 income, which would be $4,500 required even if no employee makes a contribution. This is, by the way, I skipped over this part. This is if that employee makes $150,000 a year. Now, going through the percentage scales, you can see the basic one would typically be matching 3 for 3, 100% match, a total of 3 or $4,500, and then 100% match. And that would be for the 3% or the 5%. And this is the common one. You get 4%, a total of 4 for your 5. And so what you would be getting is $7,500 of your money would be put away, and you'd get $6,000 of free employer paid to you without any additional money. Now, the beautiful thing is that if the employee puts away 6%, you do not have to do any basic contributions because, again, they max out after 6% of contribution. Now, again, it is perfectly safe and legal for you to do this. Once again, you do have to make sure that you have your deadlines ahead of the year. You can backdate them for January of that year, but you do have to apply and you have to provide your employees with all of that information as soon as possible. It must be provided to them in writing. Talk to your lawyers, talk to your CPAs about setting up one of these plans, but I do highly recommend this is a way that you can very much so legally, escape the discrimination test. Not that you're trying to be that, but you're just giving everybody the same option up front. And remember, with the basic contribution, which is the most common one, again, you'll see all the major companies doing it, the 4% for your 5, you will see those happening most commonly. And you get the option, do you want to contribute to this 401k plan or not? And now, as an aside, there is one major thing that was not discussed, and this is really just the most beneficial for anybody who has a 401k plan. If you're the owner of a plan, you get to put a considerable amount more of the money away every year, tax-free, legally. If you're an employee of a company and you are not an owner, and you do not have any percentage stake in the company, then you put away the maximum $20,500 or $27,000 if you are 55 and older. I think it's 55. If you are the owner of the company, you get to put around $55,000 a year away. And that is because you are making the full allotment amount as an employee. So you'd pull back the exact same monetary amount, which would be $22,500 or $27,000, depending on if you're over 55 or not. And then as an employee or an employer, you can make an owner deferral distribution as well, which would be up to 25% of your income. In addition, that you're not, and again, in violation of these laws. So again, this is just a very brief overview, but I just wanted to give you some opportunity to know that this is something that individuals have reached out and said, hey, I'm a little worried about this, but you definitely want to look into a safe harbor matching provision in your 401k plan. If you have any questions, reach out. Thank you so much. I'll catch you on the next one.